All right, so I'm just going to start going into crude, just reviewing crude. And before I do that, I wanted to impart some info. It's some basic info, but folks just don't realize how important it is. All right, so first thing is I want to cover a topic. There's a old saying, trade with the trend, right? Everyone knows that, but what happens is we take counter trend trades all the time, and because there's a natural urge to buy low and sell high. It's just a natural urge. There's something about it, and algorithms that move the markets know this, and they actually manipulate your emotions, but that's another story. So the point that I wanted to make was that when you have certain setups, right? I'll give an example. Probably let's just say one of the famous ones, Wyckoff, is Springs. But I'm just using that example. But it could be any setup. Basically, setups or whatever. What do you call them? Signals are classified into two: on the up wave and the down wave, right? So you're either buying on the up wave or you're buying on the down wave. So let's put this here. Sorry for this is what I get trying to use paint. All right. So you basically all setups and signals, they're classified either you're buying on the up wave or the down wave. So how do you buy on the up wave? You basically look for a breakout, right? What else is there? I don't know. Some makes a higher high, new high, or some higher high, or let's say you're even on the intraday basis, you make a new high, right? New high, and the list goes on. I mean, if you use indicators, some will actually buy when indicators are oversold because they believe that that's strength. All right, so those are just some breakout above levels. So I forgot about that, right? So a lot of traders are saying, okay, if it clears this level, I'll go long. If it clears this level, I'll go short. Right? So whatever that level is, there's some key level. Say, okay, it goes above it, I'll go long. If it goes below it, I'll go short. Or some will say, if it makes a new high, they'll just get in for whatever reason, or makes a higher high, or it's a breakout. Typically, this is the one that is the model. Breakout trader above a level, whatever. On the down wave, there's also too many. I mean, let's say the market goes down and it gets oversold on any indicator, right? And then usually what you're probably going to do is, as it gets oversold, look for a cross or move back up, right? So that oversold, and then a reversal or a cross, right? The other is reversion to the mean. So we'll just use MA20, MA20. What else is there? They'll use VWAP. Or they'll use a test of the breakout. Or you'll use a spring, right? I mean, the list goes on and on, but basically they're all split up into two. Buying on the up wave or buying on the down wave. That's it. There's nothing else. Now, here's the thing. They're traders, they use all these approaches and they lose money and then some make money. So the signal is just an entry mechanism, and that's all it is. It doesn't mean that the market is going to go up or it's going to go down. It's just an entry mechanism. It just creates a consistent entry mechanisms. Every one of these work or fail. So the question is, how do you, when you get in, how do you make the market go up, or like how do you get in a good entry? And this is what I wanted to explain. The setup is on a lower time frame. It's a lower time frame is your entry. Using a setup to get in, a long or short. You don't trade the trend of a lower time frame. Lower time frame is entry. It's your entry time frame, so your risk is low and your reward are targeting higher high on the higher time frame, which makes sure that your reward is much bigger than your risk because you're targeting using the higher time frame. So on the higher time frame, just higher time frame or the higher brick size, or depending on what chart you're using, right? Higher time frame is you have to make sure your higher time frame is not just the trend. Like for some reason, folks will just see like two averages cross and say trend is up. Obviously, they cross all the time. It doesn't mean that, oh, the trend just turned up. This is where you have to use some common sense and take a look at the background of the chart. Take a look at where is it? Is it in rally mode? Is it in pullback mode? Is it in consolidation mode? But just by looking at it, you'll know. And what you're looking for is to trade the trend and to get into the markup. You could show anybody a chart and say, is this market going up or down? They'll be able to tell you. That's how markup is when the market is in execution. It's not in range, it's not in whatever. It is clearly going up. So and you just want to get a piece of the markup because it's very, very lucrative. Also, that's it. So your higher time frame is either in markup or markdown. And why am I saying this? It seems obvious, right? Okay, is markup the same thing as an uptrend? not not by indicator definitions, meaning if you take a look at an indicator, it would be okay, this cross, that cross, whatever. They could still be in a consolidation and still be in an uptrend. But when it's in markup, it's not in consolidation. It's marking up. It's an execution. Green, 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 green. All right, or red, 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 red. It's clearly in markup. It's not just a measurement of or a cross of signals or something like that. It's clearly in markup, meaning it's green, green, green. And if you take a look at the moving averages or whatever other tool, they will also give you the signal. But just don't. You have to use some judgment. That's my point. And it has to be in markup. And what you're trying to do is get a piece of the markup and enter using the lower time frame. You do not use the lower time frame. You're not trading the lower time frame. You're trading the higher time frame and using the lower time frame for entry. You're looking for higher time frame in markup or markdown and trying to get a piece using the lower time frame. This is a very important lesson, and let me tell you why. I know many use this, uh, know this, but don't apply it. And the reason is that why you want to do this is because this is directly going to impact whether these setups on the up wave and down wave work or don't work. These setups, they will not work if your higher time frame is in markdown and the lower time frame is looking like it's making a higher high and you go long on a breakout, the breakout will fail. Why? Because that's what happens. That's why. All right. So all these setups and all the other setups, like I've gone through this multiple times where I've seen the same setups, same thing, whatever. Let's say in Wyckoff, you're doing this. I'll draw on the left-hand side. It's doing this, right? It's going down, shortening of the thrust, uh, you know, had a climax as well in the background, a heavy volume, and then it rallies, and you're like, oh, it took out these highs. I'm going to go long. Why? Because it's going to go higher. But if that market on a higher time frame is doing this, and you're thinking of a long while the higher time frame looks like this will fail. It's that simple. But if you take the same thing and the same thing while the higher time frame is doing this will work. The same exact setup will work, or have at least a much higher probability of working, if the higher time frame is in markup. When it's in markup, the breakouts are working. When it's in markup, the pullbacks are working. When it's in markdown, the breakouts are not going to work. And when it's in markdown, the pullbacks are not going to work. What makes signals, and listen up because this is the point, what makes signals work or not work with a high degree of probability depends on whether the higher time frame is in markup or markdown. Now, you can believe me or not. You might say, oh no, it's because, smart money or this level or that level, or there are a lot of orders here and mitigation and this and that. Listen, do 100 trades and you will see that what makes it work and what makes it not work is whether the higher time frame is in markup or markdown. The same exact setup, whatever you're using, even MA crosses, when they cross and the market has relative strength and trend and markup, it's clearly in markup and pulls back and you get a simple cross, for all of a sudden it starts working. But even gets into oversold and does all that stuff, it starts working. So the rule is, whichever market you're trading, its higher time frame is what you're trading, and it must be in markup or markdown. Once it's in markup or markdown, you can then do whatever signal it is, I don't know, whatever, pullback or breakout or whatever, indicator crosses. They just have a high degree of working. All right. It just, of course, you have to be thoughtful, not have your, not just, you have to have rules around it and use the indicator the way it's meant to be used, right? Not just all of that. There are techniques and all that, and just do what you're supposed to do in terms of risk management as well as entry and all of that. But I mean, on the whole, I mean, I'll show you right now. Now let's go to a chart. All right, you see crude? I was saying about this, I think, a day before yesterday or something. Unfortunately, it didn't come to my level. Why? Because it's in markup. Now the breakouts, all of them, they're going to work. Look, breakout, oh, it goes up. Tests are working? Yes, tests are working too. Breakout, yes, works. And the test working? Yeah, test is working. Breakout, yeah, works. This is what's going to happen. This is what's going to happen. The breakout is going to work. The test is going to work. Here you have a cross. The cross is going to work. I can show you indicators and they're all going to work. And if you're bearish, right, if you're bearish and the market's turning and going into markup, will the pullbacks work? Barely. Look at this. 1, 2, 3. They're not working. Why? Because the market has gone into, it was at a level within a markup, and the markup initiated here. I mean, the buyers came in right here. But anyway, different story. When this is not working, the bearish pullbacks are not working. Why? Because the market is in markup. When it on a higher time frame, this is a lower time frame by the way. On a higher time frame, it's in markup. They're not going to work. They're just not going to work. Here is if you take a look at crude, there was a rally and a pullback on a higher time frame, and they're ready to go, into markup. It's already uptrend. So once it enters the markup, all breakouts are working. They don't get stopped out. If you put on the prior low, rally pullbacks are working. These are the bull pullbacks right here. Unlike the red pullbacks, the blue pullbacks are working. Blue pullbacks are working. Breakouts are working. Moving average is working. What? Is there any indicator you want to add to this? It's going to work too, right? So here it's going to pull back, test. There comes a point when it doesn't work, and that's because there's a shift on the higher time frame. That's all. So I'll give an example. So this is obvious. I mean, I'll show you right here. Look at this. We're in markup, right? We're in markup. Look at this wave down. Look at this wave down. In this wave, you have selling pressure. You have a break of this low, right? It goes all the way down here. You have a breakout right here on 14. Let me see, right there. You have a breakout. That's 14 as it breaks these lows. This breakout, selling from the top, and you have a very clear up thrust, right? You get your up thrust right there. You have your breakout. You have a big wave. It takes out multiple lows. The question is, why doesn't this work? Here you have all the signals. You have up thrust, you have indicator. They will cross if you have other moving averages or whatever. But if you have probably stochastic or something, it would cross, or MACD or whatever. So the question is, why doesn't this make a lower low? It took out, there was a breakout, broke these levels, 1, 2, 3, had this little distribution. You might see this as distribution. Where's this shit? You might see this distribution. You might see this as cause. You might see this as up thrust. You might see this heavy volume selling. This is the biggest break in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 15 bricks. Selling pressure, at least it should make, a lower low, right? And come back to test. The question is, why doesn't this work? And the answer is, when your higher time frame is in markup, sells just will not work. Here is a clear example of a quote-unquote sign of weakness. That's what this is, right? It's the biggest wave. I don't know how many waves. 2, 3, 4, 5, at least 5. More time, more selling pressure, breakout volume, heavy up thrust failure, shortening of the thrust, etc. It failed. Why? Simple answer. The market is in markup. Sells don't work. No matter what indicator you use, sells will not work. No matter what order flow tool. I saw an email where this imbecile is selling order flow tools, and eh, every 3 months he has a new order flow tool for sale. What the fuck? Anyway, so uh, now on the other hand, right? What do you look for when markup, when it gets overextended? Eventually, it will pull back, but it hasn't taken out this low yet. So now you're in like that, what they call a correction. And should you take these cells now? A lot of folks will say, yes, you should take these cells, but this is a bad habit. And what happens is eventually you will see this earlier on here and take the cells here and get stopped out. So yes, you may make money on one, but you lose money on the other. So this is bad trading, right? You might say, oh, we're climactic, it goes down, up, down, has these multiple lows, low, high, low, lower, high, lower, low. Let me take the short. Oh, I'm in the money. But it, when you're trading, you're thinking over a series of trades, not just one, not just two, but over a number of trades. So this selling this will lose money over a series of trades, even if it makes money here. After this sign of weakness, selling its test, it will lose money here. All right, and you may come up with anything saying, oh, this made a lower low or whatever. Believe me, if you take these as a number of trades, the majority of them will wind up losers. Second, first of all, the probability of success is less, and second, probability of you timing it right to get in the correction is less, because here you might think, oh, this is overbought, this is climactic, and now it's right now it's the sign of weakness. Why? This is climactic, and look, it's a big wave, biggest volume in 49 waves, right? And they say, okay, the thrust shortens, and here it's definitely shortening, and here's your sign of weakness. Let me short, I can get the move all the way back down to here. What happens? It doesn't go all the way back down to here. Instead, it does this. So the point that I'm trying to make here is you're only fooling yourself and doing bullshit analysis or whatever, and trade in markup on the long side only, and these will over a series of trades lose. And the other thing is, if you take a look at the profits, right, it's going to be very disappointing. So yes, you might over here, if you shorted, you might get 1 2 3 4 1 2 3 4, maybe a 2-to-1, maybe 3-to-1, I don't know. Okay, 2-to-1 or 3-to-1. But the majority of counter trend trades have a couple of key characteristics. One, their reward is always much smaller. Typically a 1-to-1 or 2-to-1, if you're lucky, 3-to-1. Lucky. But mostly it'll go 1-to-1 or 2-to-1. And as soon as it hits a level, the uptrend resumes. That's the first thing. Second, the probability of success is less as well. Why? Because in markup, as it pulls back, buyers buy and they take it up to new highs. They want it to pull back because it's an opportunity to get in, to get the next leg up. They know that it's going higher, because those traders who are looking at the higher time frame, all they see is a bar or two going to a level, so they're going to be going long. On the lower time frame, you might be seeing a trend develop, so you'll be fighting the traders on the higher time frame when you counter trend, instead of having them on your side. You want them on your side, so there's more pressure, buying pressure, because the higher time frame will enter and you will enter on the lower time frame. But if you counter trend, you will be selling when they're looking to buy the pullback because they see a red bar and a red bar. You might see on a lower time frame that that red bar is a wave down, and the second red bar is a confirmation lower low and making a downtrend, but it's just two red bars on a higher time frame. So when you're selling that trend break and that new trend on a lower time frame, you're actually buying, or what you're doing is the opposite of what the higher time frame. So there's a conflict there. You see, you'll be selling while they'll be looking for buys, and that's about wraps it up. All right, thank you all. Have a good night. Bye.